our final panel for today. And our final panel takes on a broad and a complex challenge of geopolitical risk. This is something we wake up to every morning. This is something we discuss every day. In a world where political risk is increasingly non-linear and media amplified, understanding the impact and not just intent is key. So, moderated by David Benyon, founder of the Political Risk podcast, I would like to welcome our next panel.
Well, thanks everybody. We're a little bit, I think, behind schedule, but it's in keeping with the sort of polycrisis, permacrisis pressure that we're all under in this new risk environment. So, first of all, welcome to the final panel of the day. And our topic is responding to challenges in an ever-changing geopolitical risk landscape. So, I'm David Benyon, founder and editor of the Political Risk podcast. I sympathise with what was referenced a moment ago about getting a phone call and not it being bad news. As a journalist, I'm kind of used to that probably being the case when I'm calling people. Just a little bit of housekeeping. Please do keep using Menti for questions. I'll keep an eye on the screen throughout the panel, and there'll certainly be a little bit of time at the end for some audience questions. So I'll just introduce our panel to start with. So immediately to my left is Jennifer Geary, Chief Risk Officer, Non-Exec, and author of the C-Suite Framework. At the other end of the panel, we have Esperanza Cerdan, Chief Risk Officer at IFM Investors. And next to Esperanza is Savannah Thompson, Head of Political Risk and Underwriting Development at the Fidelis Partnership. And lastly, Andrew McDougall, Head of Geopolitical Risk at Barclays. Welcome to the panel. Thank you. So I'd like to kick off with an opening question to everybody, but I'll start with Jennifer. And this is really an opportunity for each of you to introduce your own perspectives on this. So it's already been used, this phrase, that we're living in an age of uncertainty, or an era of insecurity, or whatever you want to call it, to describe this new geopolitical climate. So from your vantage point, and from each of your vantage points, what does that actually mean in practice? And how is it reshaping the way that you approach risk today?
Thank you, David. Just by way of brief introduction on my background, I trained as a chartered accountant in Dublin and moved with an organisation many of you may remember called Arthur Andersen. Spent a few years with them in New York and saw firsthand how poor risk management can bring down a global institution. I came to London just over 20 years ago, spent 13 years in Barclays, 3 years in the not-for-profit space as COO of Save the Children, and then most latterly as a COO and CRO in the fintech space, and a little bit in software management as well. I think Paul Polman, former CEO of Unilever, said it really well recently. I'm going to briefly quote him. He said, "We are living through what may be the most profound reconfiguration of our global systems since the 1930s. Climate collapse, geopolitical tension, economic anxiety, technological disruption, not one crisis, but many converging all at once. And in the vacuum, trust is faltering, short-termism is rising, and cynicism is gaining ground." I was fortunate enough as well to listen to a keynote by Rory Stewart yesterday, and he made the point that if you take, for example, the changes that have happened emanating from the US recently, even those closest to the administration didn't know what was going to happen before it happened. And when these tariffs were announced, immediately, for example, US banks and other organizations pulled their annual guidance because there was just too much uncertainty to be able to plan. And so when you have this level of uncertainty, obviously what you have in the markets is dysfunction, is people holding their breath, choosing not to invest, choosing not to make decisions, waiting for the uncertainty to pass. And of course, for us as chief risk officers, that makes it incredibly difficult to plan and incredibly difficult to take action. And I know we'll come on to it shortly in a second. I think what that means is that we're going to need to alter our response and do things differently to how we've done them before.
So if I move on to Esperanza next.
Thank you, David. Our vantage point is that of a leading global infrastructure manager. We are owned by 15 Australian pension funds and also by Nest, the UK pension funds. And we are headquartered in Melbourne, and our purpose is to invest, protect and grow the retirement savings of working people. IFM is a patient capital investor that is seeking to provide the kind of steady returns that pension funds require. I think the current era of insecurity is reshaping the risk landscape, and it's having impact across, that they are manifesting across economic, geopolitical, technology and social dimension. And it makes even more crucial from the CRO perspective to have an enterprise risk approach that integrates insights across the organization to be able to anticipate future threats and strengthen resilience. All these raising trade frictions complicate supply chains and increase costs. And also the policies are increasing. The policy changes that we are seeing are reducing the investors' confidence. After all, infrastructure takes many years to build, and that translates in potential higher cost of capital. There are also economic headwinds that we are observing, like rising inflation, rising interest rates, tighter monetary policy, which is translated into increased financial costs, pressuring valuations, and is testing the resilience of the portfolio. Therefore, resilience and risk management have become paramount. How are we reacting to that? I think the first one is holistic risk mapping. I think it's crucial to identify emerging risk, but more importantly, as has been mentioned before, interdependencies between those risks to ensure that mitigation techniques are robust, but also forward-looking. The second one that is also quite crucial is collaboration and fostering that close collaboration between risk, cybersecurity, operations, and obviously the investment teams to have a unified and proactive approach. But also it's very important to bring different perspectives into the table to avoid what all risk management want to prevent, that is group thinking and also biases. And I would like to just finalize saying that building resilience and continuously adapting our strategies to maintain reliable and safe infrastructure services under all conditions is also crucial.
Savannah?
Yeah, thanks, David. So I'm Savannah Thompson, and I run the credit and political risk book at the Fidelis Partnership. So we're a service NGA that underwrites on behalf of a number of third-party capital balance sheets. So the biggest provider is Fidelis Insurance Group, and we also underwrite on behalf of Lloyd's of London through our syndicate 3123, and a number of other third-party capacity providers. So the main line of business that I underwrite is sovereign non-payment and political risk perils, and we allocate the risk to the appropriate balance sheet. So really my role is to ensure that the clients that we work with investments or assets around the world in higher risk regions are protected for those surprise economic or political shocks. So in terms of the sort of era of uncertainty, we've definitely seen a sustained heightened risk environment over the last 5 years, whether that's trade disruption, global conflict, pandemics. And I think from my perspective, working in the insurance industry, what it means is we have to have foresight and flexibility. We've got to be reacting real time and ensuring that we're using different forms to essentially monitor our risk more accurately and faster, and provide the clients that we work with the same service levels, but also while protecting our stakeholders at the same time. I think one of the things that we have implemented and we do well is this real-time risk assessment. We have twice daily underwriting calls, and one of the good examples is obviously in the recent weeks we had the tariffs announced by President Trump, oil price volatility. We were able to use those twice daily underwriting calls to essentially create differing factors like tariff vulnerability indexes for each country's oil price volatility, and it meant that we were able to take a view on different structures, pricing and assessment of risk for new transactions coming through from our long-standing clients.
And Andrew?
Thanks, David. Yeah, I've only been at Barclays 4 years. I was a former soldier and diplomat, so it was a bit odd to join a bank. But what is my job? Actually, my job is about making sure our leadership, our group chairman, our board, have a better understanding about how these issues impact markets, risk, strategy, and our clients. When I first joined, there was a bit of a understanding that geopolitics did not impact markets necessarily. You know, it was a bit of a bad news story rather than actually, it's just geostrategic issues. It's the environment we operate in. So how did we adapt to that new era? And the first thing is making sure that everyone at leadership level at the bank and all constituent parts of the bank understood that times have changed. The 80-year post-war security, trade, and financial infrastructure is fundamentally changing. And we're not going back to the way it was. I'm not saying it's being hysterical or it's just saying it is changing. We need to adapt to it. So almost having someone that wasn't a banker to be able to tell our leadership in a way that's probably not right, you should probably worry more about that, it's been really valuable. And actually now there's a realization that geopolitics is just making sure we have a consistent understanding about these issues across the bank, and it's not just risk, it's across the business and all elements of the bank and all functions.
I think when it comes to the new era and what's changed, it does feel like the time constraints, the immediacy of things has got so much harder. I mean, Savannah mentioned, twice daily underwriting meetings to discuss what's going on in terms of tariffs. And I remember the World Economic Forum talking about a poly-crisis environment or a perma-crisis environment where it's literally the next thing on Monday morning is going to hit you. So, Jennifer, a question for you. All that uncertainty makes planning horizons a lot harder. Yeah. And the difficulty of building meaningful scenarios. So how would you say risk professionals can try to stay ahead of that curve, even when the most near-term forecasts can feel unreliable?
Absolutely. It feels like we start the day and we really don't know what's going to happen next. And I think leaning into the theme of today, which is about, as chief risk officers, enabling growth, I think the challenge to us in this room is to dial up and lean into those skills, those things that we are so good at, right? That horizon scanning, that evaluation of outcomes, that assigning of probabilities. I think I looked at sort of 6 things that I think we can do now immediately as CROs. I think we need to increase the degree of discussion we have around drivers of our economic success for our organizations. What are the things that are most going to be influential and in what ways could they impact performance and risk? I think we need to lean into our scenario modeling. We need more data. Even when at times it seems, for example, like regulation, if you take, for example, in sustainability, so, some questions about CSRD applicability or even CSDDD now, what are the no regrets activities that your organization is going to need to do? You're going to need to track your carbon emissions, for example. So lean into that data analysis where it's meaningful and kind of don't be too influenced by the vagaries and the kind of sways in regulation that may happen. I think we need to get our boards and excos much, much more accustomed to speaking in terms of ranges of outcomes and speaking in terms of possible outcomes and a range of possible outcomes rather than having singular plans, and to help our board members and exco members be prepared for those plans to change. As Keane said, when the facts change, I change my mind. What do you do, right? So we need to be prepared for our plans to be much more fluid and for our strategies to be more agile in responding to change. Double down on your organization's strategy and its values, what it does really, really well. Go back to those basics. Think about what your organization can do even amid times of great change to continue to serve its customers. And then finally, we've used the R word, resilience, a lot today, but I just want to clarify, when I think of resilience, I'm not really thinking about DORA, I'm not thinking about FCA resilience, I'm not thinking about spreadsheets. What I'm thinking about is true resilience in our operations and where they take place, resilience in our people so we don't have key man risk, resilience in our processes so we can manually fail over, resilience in our technology, so we might need to change where our data is housed, or indeed things like our use of cloud infrastructure. So resilience, as Toby said earlier, in our supplier and supply chain, thinking about more local suppliers versus those further overseas. So really leaning into true resilience in our operations to make sure that our organizations are future-proofed.
Esperanza, I'd like to turn to you next, because infrastructure investment is sometimes seen as an island of long-term stability. Here's a metaphor, the shifting sands of geopolitics that we're seeing, so strategic competition, resource nationalism, political instability, all of these things, how are they changing the calculus, in your opinion, for asset allocation?
I think you are absolutely right, and portfolio allocation is fundamental. And as I mentioned earlier on, we are a long-term investor. We hold infrastructure assets for decades, and we have a diversified portfolio geographically and sectorially, and it has been or has demonstrated to be resilient across political and economic crises. Let's take COVID as an example. While some of our assets struggle, and airports is a really good example, there was literally no traffic. Ports and terminals were doing a roaring trade. Also, utilities are considered a basic service, and normally they have regulated or contracted cash flows. I think the medium risk is that elevated geopolitical uncertainty and protectionism will undermine global growth and stability, and will have knock-on effects. I think as a developed developed markets core investor, we expect to be less exposed than some, but definitely the economic consensus is that it is going to impact GDP growth and may increase inflation. From being an Australian infrastructure investor, from an Australian national perspective, this slowdown on global trade and capital flow is an economic risk. 1 in 4 jobs in Australia is linked to trade. Also, China, who has been the target of the Trump administration tariffs, is Australia's largest two-way trading partner, and it accounts for over a quarter of the Australian goods and services trade with the world. And I think Lou mentioned them earlier on. We are also seeing opportunities. Energy transition in relation to energy security is one, and governments are prioritizing domestic renewable energy capacity. Also, the need for resilient digital and data infrastructure is important, mainly driven by AI and digitalization, and is creating significant opportunities for us to invest. Also, if you combine that with innovation and emerging technologies, it's also attracting investment, and one example of that is the integration of clean energy into the hyperscale data centers. It was also mentioned the fact that the governments are looking or are seeing infrastructure as a tool for a strategic resilience on autonomy, is providing opportunities in greater public and private partnerships, and there are incentives to invest in critical infrastructure. And I would say, just to finalize, infrastructure provides an inflation protection. It has predictable long-term revenues and resilience to economic cycles, and is particularly relevant in this time of uncertainty and volatility.
Well, let's stick with opportunity for a moment, because I feel like that has been a recurring bit of a leitmotif for the discussions today. And risk professionals always know it's the other side of the coin, isn't it? So Andrew, a question for you. We've talked before, and I know you're keen to add opportunity, or substitute or add it to geopolitical risk whenever possible, or even just talk about global affairs. Now, that's not just semantics, is it? Why do you think that's important, and particularly for the way financial institutions think about geopolitical exposure?
Yeah, I mean, the main issue is, I mean, when I joined the bank, as I said, geopolitical risk was kind of, oh, here's Dr. Doom, you know, talking about bad things. Instead of just, you know, what's that environment we're operating in? How do we adapt, whether it's tactical, operational, strategic decision-making, entering, exiting markets, FX next week, whatever it might be. So what I really wanted to do is just be clear to say it's not just bad. And I know it's been said ad nauseum this morning about adding that opportunity, but in fact, if you get away from just that phrase geopolitical risk and add or change it to global affairs or geostrategic issues, whatever it might be, it just clarifies what it actually is. It's the environment we are operating in, how do we adapt to that? And in a way, that's the next step. And we're not going to go back to where it was. You know, just look at the equity markets following the US-China discussions. I don't want to call it a deal or an agreement in Geneva. You know, S&P's back to where it was or even above January levels. But the reality is, well, yeah, that's an opportunity in the short term, but longer term deterioration is still a bigger issue. And there's lots of different markets and sectors that can gain and lose from that. So in a way, it's just that general understanding, preparation for what is coming. And you talked about scenario analysis. Certainly, we at the bank ensure that we are exercising, we are practicing the most likely scenario, not just regulator stress tests, but what do we think is coming? And my role for the leadership is to say, this is the scenario. This is what we think, and legal and compliance and risk and all elements of the business actually have to be on board, and we practice it and learn lessons. And without doing that, you can never know what's coming, because they will always be shocks rather than, yes, we understand what that means. We understand what we need to do.
Let me stay with you for a moment, Andrew. So from your perspective, I did write the phrase geopolitical risk, but let's call it geopolitical dynamics. Which of them do you think are maybe receiving too much attention versus too little, or maybe misjudged or underappreciated? Can you give, I mean, we've heard a lot about lots today already, things like tariffs, but can you give one or two examples of things that perhaps concern you most?
Yeah, I mean, the big issue, the big risk we all face actually is there's so much information, there's so much noise, but what does it really mean for your organization? What does it mean for your organization's clients? So yeah, the risks, we kind of all know them, we've all heard about them, but what really matters, you know, back to that US-China point, that relationship, that deterioration over the coming years is vital. And you heard Scott Bessant the other day say, and I think markets probably forgot about it or misrepresented or misunderstood. He said there will be a strategic decoupling with China on, he called it chips, but you can replace it with advanced technology. That is coming, and it's not about tariffs. It's about export controls. It's about sanctions. Who controls all of the rare earths and critical minerals? China. How long does it take to build a refinery in the US? More than 5 years. So actually, don't just look at the bull market for equities at the moment, look longer term. Secondly, US debt, we all look at it, hear about it all the time. That 30-year treasury breaking 5% and coming back down is really important. I'm not great at maths, but I know tax cuts and spending cuts in the US don't actually equal each other at the moment, hence why the bond market is reacting. Physical climate risk, we've almost forgotten about it. Remember last year, the monsoon in India was erratic, it didn't fail. It caused Indian government to put export controls on rice. What did that mean? Inflation in the Philippines went up 4% and other ASEAN countries overnight. So in a way, don't forget physical risk, Arab Spring. We don't really need this at the moment with all the other issues going on. And then finally, quantum computing, cyber, you can wrap it up. You know, the advanced tech supply chain is breaking. China is investing a lot into quantum computing. They have the minerals, they have the rare earths, they have the software, they have inefficient chips, but the hardware is coming. And in a way, a quantum computer on top of that will give them a real advantage. And when you add Taiwan risks, we should expect an economic quarantine at some stage. I don't mean with the military, I don't mean the PLA. I just mean, you know, testing US policy. There's just a lot of misjudgments maybe or misunderstanding of some of these risks.
Yeah. Well, Savannah, I'll turn to you then. Already touched on credit there. and obviously you're in the credit and political risk space. So insurers need to deploy capacity nimbly and thoughtfully. Are there some markets that you would describe as outright too risky, off risk, in broad terms? Or is this more of a question of how you might structure coverage towards individual clients, how the terms may shift?
Yeah, absolutely. I mean, as an insurer, I think that it's our job to provide clients with solutions, and obviously operating in the credit and political risk space. There are lots of markets in the industry. If it doesn't fit within the specific underwriting criteria, they're very quick to say, no, we can't do that, it's too risky, not one for us. And I think that's a common complaint from clients with the insurance market. I think at Fidelis, we do pride ourselves on the fact that the answer is typically a no, but let's see what we can do, what other structures we can look at to try and make it work for you. And I think that's where the real-time, nimble analysis that we take every day comes into play. And I think a good example of that is in the wake of Russia-Ukraine, the political risk peril, which I'm not sure a lot of chief risk officers at companies around the world maybe knew was available to them. And post the impact of Russia-Ukraine, there became a huge demand for the product. And obviously that's perils like expropriation, currency and convertibility, and so extremely useful tool for maintaining that risk at the level that companies need to keep competitive and to build a resilient business. But we saw a huge demand for that product, and a lot of markets were a bit nervous in the aftermath of seeing claims arising from Russia-Ukraine. But I think our view is that we've just added different underwriting factors into the analysis to make sure that we can offer something. So a good example is they used to be large multi-country policies. You had one limit, and if one country had a loss, the client didn't have a limit for the rest of the year, and they ran for multiple years, and so not exactly the most cost-effective policy for a client. What we look at is depending on the domicile of the country, with the assets in the higher risk country, we'll look at structuring sort of single country products. We'll maybe look at doing shorter policy periods, and we try and structure something that, you know, A, works for the client, but B, also works for us, because it is a balancing act between giving the client something that works for them, they're getting something that they're paying a premium for, and it's actually going to pay out in the event of a claim, but also we're making sure that we have a stable, diversified portfolio that can absorb the losses when they do come. And I think a great example is just a factor that we've added into our political risk policies. And very simplistically, a UAE domiciled company operating with assets in China is very different to a US company these days operating in China. And so that would get more favorable terms and a more favorable structure from us than the US policy.
I'm going to switch to a question from the audience at this point. So I'll ask the question first and waffle on for 10-20 seconds to let you each think of how you might respond to it. So how do you judge the quality of the insights you receive about geopolitical risk? Now, I like this one because I was at the breakfast this morning with some of the speakers, and the question came up, and it's been a recurring theme as well today, that, you know, the role of the risk manager used to be derived from compliance and quantitative and actuarial science skills, and very data-driven, and the comfort that comes with having all those data. But geopolitical risk is not a type of risk that is well endowed with data. There's a definite lack of it, and that then puts emphasis on the sources that you use, the quality of those. It is a case of qualitative rather than quantitative sometimes, I think. Without naming names in terms of which suppliers you use, maybe the types of tools or, so I'll just repeat that again, how you judge the quality of the insights you receive about geopolitical risk. Who'd like to take that one?
Well, I'll just give a brief answer. So for example, I devour everything I can get my hands on from the Economist Intelligence Unit. RAIN I find incredibly useful. The Marsh report that was mentioned earlier on today. I think it for all of us, so I come from more of an operational than a quantitative risk background, so I think I'm a little more used to thinking about scenarios, eventualities, processes, slightly softer forms of risk. But the single biggest investment I'm going to make in my development this year is to take a 3-day course in geopolitical analysis, which by no means will make me an expert, but maybe will allow me to ask better questions and filter the information a little bit better and make a better link between the geopolitical change and what I need to do, internally as well. So.
Sure.
We'll get you back to Barclays.
Sure, sorry, go ahead.
I mean, there's a lot of noise, back to that point. There's a lot of consultancies, there's a lot of information, and actually, within the bank, Barclays has 90,000 employees. The information is actually in there. It's just making sure different parts of the bank, whether the global markets or bankers or risk, aren't just getting contradictory information from different sources or consultants. So in a way, we're becoming much more careful in what information we use, maybe becoming a bit more picky might be the right word about what information, because actually maybe I disagree with you slightly. We do have the data. The geopolitical data is there. You can look at currency fluctuations week by week. You can look at lots of different areas and in the past. So in a way, we rely on that. But I do say to lots of our senior leaders that please don't get your strategic information from Bloomberg. That's all I'll say. It's great for data. It's unbelievably good. But actually, it is a for-profit channel. It's great, but longer term, maybe it's not probably the best place.
I got a different question, a very different question. I'm just going to ask it because I'm not quite sure how you want to approach this one. But why have Brits lost their appetite for eating each other's lunches? If the answer involves that we are embarrassed at our own history of eating too many such lunches, how do we get over that embarrassment? I don't even know where to start with this one, but if anyone wants to even have a go.
Definitely from those that are Brit, not me.
Yeah. Well, go ahead. Have at it.
I don't even think I understand the question.
No, I don't think.
Neither do I, but it's come up there.
Do you know what? I think I do. It's literally just we should understand that we have a lot of positives. It's not all bad in the UK. It's a great destination, our legal system. We all know all that, the soft power. And as things change, we have the ability to actually try and recognize that and be a bit more proactive, a bit more positive. There are other markets around. I don't mean the US-UK trade discussion. I don't mean UK-India. I don't even just mean the UK-EU. But there are real opportunities. We can use our history for good, for more proactive investment decisions. But yeah, it just depends what it is.
Okay, I'm going to return to, this time a question for both Esperanza and for Jennifer. We're a little bit constrained by time, so there's a perception of risk professionals as being naturally conservative. We've heard this already today. But risk, we've already heard, is also always a source of opportunity, or almost always. So in your view, how does the risk function shift from being this department of no, or Dr. Doom, however we want to phrase it, to enabling strategy and enabling growth in a way that senior leadership can enact on that?
I think being called Dr. Doom is kind of cool, actually. But I think there was a really interesting article in the FT last year about one of the top UK banks that was laying off a lot of its risk staff and reorganizing because the risk department had become a blocker. And I remember I posted about it at the time in LinkedIn, and it got an enormous response, like 100,000 responses, because something has fundamentally gone wrong, hasn't it? If that relationship gets to that point. And the study that Bays have done, and it's a great read, I encourage you if you haven't yet read it to do so, does talk about how we need the first line to think differently and how we need our boards to think differently. But I also think we need to challenge ourselves as the risk profession. We need to help our colleagues see that we are just as invested in the success, the long-term, sustainable, responsible success of our organizations as they are. That means we need to have really thoughtful, strategy-led risk appetite discussions, not sort of woolly, oh, we've got zero tolerance. No, really, like you can't have zero tolerance for cyber risk and be in the world today. You can't have zero tolerance for market risk or credit risk. So let's lean in and have really proper, meaty, strategy-led discussions about where we want to get to, how we're going to succeed, and the potential upsides and downsides of the different approaches on that. So I'm advocating for a much more commercial, strategy-focused, risk-led discussion where we keep all of the abilities that we have, but we hone them in furtherance of the achievement of our strategic goals.
Great. Esperanza?
Yeah, no, and I agree, and I have a slightly different perspective. I don't think all chief risk officer and risk function are a no function. And coincidentally, I'm going to quote another article that I read about that published by McKinsey, that basically they define the different chief risk officers archetypes. And this was based on a survey of more than 30 CROs from mainly the financial services and globally. And basically they identify 3 archetypes. One is the architect, that has a desire to leave the risk function better than for the next generation, and basically focuses on building and institutionalizing world-class risk capabilities and culture. The second one is the protectors, that is motivated by creating highly responsive risk organizations that can handle whatever is thrown at them. And the third one is the business accelerator, that is motivated by maximizing business growth and profitability while remaining vigilant about risk. So I think there is a variety of personas on the CRO roles. I took the survey, and I'm more the architect, but what I can say, I see risk as a strategic tool. And the vision that I give to my, because ultimately we are in the risk on the business of taking risks in order to make returns, right? And it's understanding which risks facilitated business growth and which risks are a cost to the business. That is mostly, I mean, you were saying cyber operational risk as such, but there is always a trade-off between cost and mitigating risk. So I think for me, I think it's crucial to have that strategic approach, enterprise mindset, and look risk not only as a loss, but also as a gain and where the opportunities lie. So, yeah.
Okay, so what you guys can't see, but I can, is there's a timer here. We have just under 4 minutes. So I wanted to ask one last question to each of you, but obviously you've only got not quite a minute to respond to it. Each is looking ahead, maybe 3 years, maybe a little bit more. How do you feel that the changing geopolitical environment is going to change the role of the CRO in that time period? Go on, Jennifer.
I think we need to up our game. We need to lean into this new area of geopolitical risk and make it a fundamental part of our risk assessment tool set. We need to engage in the discussion. We need to continue to be knowledgeable and clear, and we need to get off the fence. And I think in 3 to 5 years' time, we will be judged retrospectively as to how we responded to this challenge in our time.
Okay, Andrew?
I think we're on the right track. Certainly, it's maturing. I can only speak from the bank's perspective, but certainly the understanding is getting better, our understanding of the risks and opportunities to come, and certainly being a little bit more confident to make decisions more quickly, because we have prepared much better, and in 3 years, that will just increase, and we won't get sidetracked by risks to come. There are real opportunities. Think European stimulus, UK as an investment opportunity. There are things to come. So I think we are much more mature today, and 3 years just get better.
Okay, Savannah?
Yeah, I think CROs will take an increasingly central role within most businesses, if that's fair to say. And I think that they should be more proactive. I think taking some of the real-time risk assessment that we look at, I think should be implemented. I think rather than historical data, I think it should be looking at what's the next emerging threat, how do we build resilience as a company when we're operating in high-risk environments. And yeah, I think that's really important.
Yeah, I think the CRO role has been constantly evolving. I think that is my perception. I think definitely I agree with Jennifer. It's becoming broader, and the skills and the knowledge that the CRO needs to have, particularly with all the technology advancement, is crucial. I think it's also important to have this enterprise risk approach that you say. Very important to engage with senior management and board, the role that Andrew you do. I think that is. I think it's important as well to continue in investing and empowering the risk function and training them. So it's not only on the role of the CRO, it's that responsibility, and think about succession planning. Because I think the role has evolved from, before, before it was all very data driven and very quantitative. I think qualitative aspects are going to have more importance. I think also transitioning from measuring risk to managing it, I think is also important. And I think the reality is not stationary, so having this reality that is dynamic and reacting to that.
Okay, one more question from the hip, from the audience. I suspect it's the same person as that one earlier about stealing sandwiches. Has the UK lost its nerve and innovative qualities? And if it has, how do we regain that? I mean, I don't think it has at all. But
I think we probably did a little bit, but I think we're regaining it for lots of reasons. Confidence is returning, but it's not all good news. There is a reality, but yeah, I think we did lose it, but we're getting it back.
Okay, great. Then I think we're out of time. So please, would you show your appreciation for the panel? Thank you very much.